Hey y'all, welcome to the stream. Let's get this going. Make sure I turn this thing off this time instead of leaving it up for the entire stream. Okay, let's do some stock market analysis. You're gonna need a drink for this one. I suggest buckling up with an alcoholic beverage because I certainly have one myself. Okay, so let's dive right into the date. First off, I'm gonna do the old legal disclaimer bullshit that we got to do. Not a financial planner. I'm not a fund manager or a financial professional. Professional. I don't hold any designations or certifications. This is purely economic commentary and market commentary. Don't take it as advice that you should base trades on, and I'm not responsible for any losses you might incur. So don't bother me, okay? Just listen to what I have to say. Anyway, okay, so you can, we'll do a little analysis here, and at the end, if anybody has any questions or whatever, we'll do some Q&A, and maybe I can try to soothe somebody's fears and worries, because I'm sure after another week of this bullshit that we've had, you have some more anxiety. Not like you need it anymore with everything that's going on, but I mean, it has not been a friendly market environment to anybody. So I've kind of did some digging, some research. I was on night shifts for the weekend, and yeah, basically as this whole thing's unfolding, and plus you add on top of it this whole coronavirus mess. I mean, my eyes have never been more glued to my phone or my social media than they ever have before, and so needless to say, my weekend at work wasn't very productive. But before you judge, I'm sure you can look back at your work week and say you probably didn't have the same. You probably had the same productive work week that I did. So yeah, I got a lot done. Got to read a lot, and I can kind of offer some explanations as to what's going on in the market. So look at the last couple of days. Since the weekend, the market kind of hit a bit of a top at resistance, and then tried to rebound, didn't, and then ended up lower on the day. We ended up busting through a support line again, and then ended up where we're at now. Kind of bottomed out a little bit down here. We'll see if it holds. I got a little rally later into the day. So let's take a look at what that looks like as far as the daily chart. And you can kind of see where it broke down to that from that prior support line, which actually I'll turn the volume off here and then turn that overlay off. And you can kind of see that candle a little bit better. Yeah, there you go. Okay, so sorry, I'll try not to cough in the middle of the stream here, and if I have to, I'll mute my mic really quick. So if you just all of a sudden see me or hear me disappear, that's why I'm still getting the remnants of a cold 2 weeks ago, but I'm better now. It's not the coronavirus, just so you know. Okay, so anyway, so yeah, failed to hold that support line previously, broke through it, but then ended up closing back above it. So we got a rally from there. We'll see if that holds like that. And you zoom out to the weekly chart that gives you a little more context. It hit the support line and ended up recovering from that previous uptrend line, which is a good thing. I think this candle shows that there is still some buying pressure in the market. I mean, it's kind of the bulls and the bears are fighting. They're in a war right now to stop the market crash. You had less pronounced of a candle here like that. They call it a doji gravestone, or yeah. So it's a candle that signals indecision. If you see it at the bottom, usually a good thing, or a better looking thing, I should say. I mean, you've seen it here too, so yeah. Who knows? All bets are off in this market. I'm not going to pretend like I know exactly where this thing's going, but we just got to play it day by day and look for the signs, right? So yeah, and as you can see that there, oh yeah, I was going to point out this. That's what I was looking at. So we're getting a little bottoming action in the RSI. It's starting to trend upwards just a little bit, but it's still in this oversold zone. So I mean, if it stays there, that could still imply more downtrend. So if we end up going back into the oversold zone and maybe even go lower. You can still see more downside there maybe. And here we're not quite, I'm going to zoom out maybe to the financial crisis and show where we're at as far as oversold conditions. So when this gets so oversold like this, the selling pressure starts drying up and then more people are starting to buy. So that happened here in the financial crisis, which didn't signify the bottom, but it signified that we're getting close to the bottom. So it hit this, moved down further, and you had this higher reading on the RSI, and then the bottom was the last bottom was another higher reading. So that means you're getting more consolidation. The market's starting to get a little bit more stronger. So we're quite far off from that. I don't think this is going to be the bottom by any means. Who knows how long it's going to take to get there? I mean, look at the financial crisis. I mean, it really started in 2007 and went to like mid 2009 before we ended up bottoming. So these aren't like super quick moves as far as finding the bottom. What the super quick move is here is how fast we've gone off the cliff. I mean, the market is continuing its fucking kamikaze dive into the dirt, and yeah, very volatile. I'm going to get into why that's happening like that soon here, and try to explain a little bit what's going on. So I want to look at the oil market again. Oil, yeah, is completely shitting the bed, just like I thought it would, and it has gone lower than my target. I figured about maybe 21, and right now we're sitting at 2083. That's where it closed today. If you zoom out to the monthly, we hit that trend line. It looks like it's a little bit holding the trend line there, but I mean here I drew the same one. It's more on the weekly chart, and we look like we're a little bit below it. So if we break below it, I mean I don't know where we're gonna go. I would think probably like, I'm pretty sure I looked at it earlier and it was like $11 on a barrel of oil, or maybe less than that. So yeah, the next one's at about 16.49. Next one here, 10.97. So yeah, hopefully it holds. Maybe we'll end up pushing a little bit lower and get a bottom wick on the candle. So a wick would be like this this unfilled part, which means that the market went down to here to this point and then cruised back up and rallied to close up here. So maybe we'll get that happening over the next few days here. We'll see. Just got to watch for tomorrow. And oh yeah, I'm going to be doing a live market stream all day on Friday. So set your fucking alarms on your phones. I'll be on at 7:30 a.m. right for the market open. Hopefully we'll get another crazy kind of volatile swing so he can show you guys and I can make another video. I hope you liked that little intro video I made there. It was pretty good on the timing of my I can't even remember what that composer's name is. Whatever, anyways, it doesn't matter. So yeah, I'm going to be doing that all day. So anybody can jump in and listen to the stream, watch the stream, and shoot me any questions or whatever you might have. So yeah, market for the oil market, I mean, it's going to have to bottom more before we see the swing that I thought we might see. At this point, I don't know. It doesn't look like selling's done. I mean, we're not even oversold here. So who knows how far this is going to go. I mean, we don't necessarily need to be, I suppose. I mean, you look at this cliff dive here, and it didn't even get into oversold territories before we rallied. But that was, at the point of like massive fiscal stimulus, which at that time helped, and this time it's not. And we're doing more fiscal stimulus and quantitative easing now, so that means the Federal Reserve is injecting more money than they did during the financial crisis in order to get them out of the financial crisis. And today it's not working, so that's had no effect on the markets quite yet. Okay, so looking at commodities, it's a bloodbath. It's all red. It has been completely shit over this last month. I mean, you look at crude oil down 57% or 58%, I guess if you round it up, 63% year to date, which that's crazy. That's a huge drop. One day we went down 18% again. We had that record drop the other day that was 25%. That was last week, sorry. But it's a total sell-off in this market. Nothing is really holding except rice, which is weird. I should have expected it. I mean, you think like where's all the world's rice come from? Well, mainly China. So I'm thinking, yeah, the supply chain disruptions of they're pricing that in, and probably maybe we're going to be looking at higher food prices eventually. I don't know, but the price of rough rice is going up. So I mean, 1 week we're up 10%. Okay, sorry, cough break there. Um, Another one, I'm kind of thinking like if rough rice is doing the same thing, and I've talked about coffee in the past two videos, maybe we'll get the same thing happening with coffee futures now that I mean I know Colombia's border is shut to foreigners, so I mean maybe they're thinking supply chain disruptions now. They just shut the border between Canada and the United States now, so I mean that's a big flow of traffic of goods. I mean not coffee obviously, but well coffee coming in but not going out. So but yeah, but it just ramming the point home of supply disruptions and yeah, so we could see prices end up shooting up because of that on the consumer goods front, but not so much on the um, base materials and raw materials front, which obviously just looks like it's taken a complete nosedive. I mean, look at gasoline, 41% in 1 week. Pretty crazy movement. Okay, so everybody seems to be looking for an explanation to this market carnage, and rightly so. But the problem is a lot of the explanations that are being given in the common media are just that it's the coronavirus, which is not completely true. I mean, it is kind of true, but the coronavirus, I can sum it up like this. Is the coronavirus is this guy hammering at this wall. And watching this video, you know this is going to end perfectly and nothing bad's going to happen, right? Not at all. How does it hold that up just by that little piece? Yeah. So yeah, the coronavirus is that dumbass with a sledgehammer. It was the pin that pricked the bubble, and this has been a building wiki foundation for quite some time. Probably you could trace it back a good like 20 some years. That the financial system has been just slowly being degraded, and the foundation is rotting or was rotting, and then finally it just took an externality, which is an outside event from the economy, to finally just kind of hit it that one little extra swing that it needed to take that fucking wall down, and now we're looking at major market problems. So I kind of need to get into the way debt is created in order to explain this. So I'm just going to like explain to you guys here, just maybe with a notepad and maybe some numbers. So basically, when the government wants to create debt, they need to issue a bond, and they issue that bond by just taking that money. They print it through the Federal Reserve. So I'll say this in the case of the United States, just because it's a little bit easier to explain, and it's basically the same thing as the Bank of Canada. They have a few different powers, but roughly the same idea. So they take $1 million and they just create it, and so they'll sell it to the market. So the market takes it. So say we need $1 million to fund the government. So take that money, sell it to the market, and you promise them a rate, so 1%. So it just in the form of a bond. You've heard of bonds, Canada savings bonds, stuff like that. Canada savings bonds are government debt. In the United States, they call them treasury bonds. So said I'll sell you this treasury bond for $1 million, and later on, when the treasury bond matures, I'll pay you the 1%. And so that's how they issue debt. So debt is soaked up by the market, and lately it's been soaked up by the Federal Reserve, who, I mean, I don't want to get into this too complicated and make it like your mind spins around, your head explodes, because it can go there. With the monetary system is very, very, very complicated. But if we just think about it in these terms, debt is just a bond, and they just sell it to somebody who is willing to buy. So Um, so the problem is in what's been happening lately is there's been problems in what's called the repo market, and the repo market is the market which banks are allowed to lend each other money overnight. So, say in this case, if a bank needs, say, $1 million overnight, they'll go to another bank and say, okay, I need this $1 million. I have this $1 million bond. I can trade you this $1 million bond for the cash, and then the next day I'll pay you whatever the rate is, and or maybe they'll negotiate something else. There's kind of it falls within a narrow band, but they have this rate at which they can trade. And so the banks usually say, okay, well, here, I'll take your bond. Here's your cash, and then tomorrow you pay me this amount of money. And it's all this ensures is that the banks have free capital all the time, so they can, if they need money, it's not a problem. They can go to this market, get the money, and they're not going to run any roadblocks that way. So it just makes the market really liquid. So this is a liquidity thing. So um, so that's the way debt is created. So these banks have these treasury bonds, which they hold a lot of them usually, and so they're able to trade these back and forth. So the problem is now is that there's been so much of these treasury bonds issued, and interest rates have stayed so low that nobody really wants to buy them. It's not good collateral. So when they're offering these bonds, these banks are looking at these and going, well, I don't really want to lend you these. And so there was a bit of a stall in the market, in the repo market, that started happening months back in, like, I think October or November. And the Federal Reserve, so the central bank, had to kind of come to the rescue and start pumping cash into that market in order to keep it afloat, because nobody wanted to give up their money. So they were thinking, okay, I want to hoard cash. And usually when they're thinking like that, they're planning in terms of, okay, if I might not have this cash later and I might need it, I might be incurring losses, and I can't afford to lend this money to anybody else. I need this money. And so that's where this seizure in the credit market started happening. And this kind of started happening before this, like I said, back in November, before anything really bad started happening in the past few weeks, and especially before anything started happening with coronavirus. So this is completely separate from coronavirus. So when this started happening, like I said, the central bank started injecting money into the system, and the weird thing is nobody's still changing these bonds. Nobody was basically taking it. Like they're yeah, nobody, it's not moving. Put it in simplest terms, money's not moving in that market, and this is causing a big issue. So when the market started selling off, the problem is everybody now started thinking that dollars were king. Cash is king. And you'll notice that because, like, typical safe haven assets, like bonds. So treasury bonds are usually a safe thing, perceived as a safe thing. It's government debt. The government always pays you. That they never default on their debt. Like, especially the United States or like a major country like Canada, right? They never default on their debt. Fuck it, wrong. That can possibly happen for sure. Just needed a sip of some brain juice there. So, I mean, it has happened before, especially in the West. We've had, you look at Germany, and the Weimar Republic went basically broke and had to default on their debt. So it can happen. So now that everybody starts hoarding dollars, there's no cash available to fund transactions in the market. So this is called liquidity, basically. So liquidity means securities, or sort of liquid assets mean securities like treasury bonds, stuff like that, that are able to be freely turned into cash on a whim. Just like you snap your fingers, I can sell that bond, I can get the cash for it, and then I can use that cash to pay out people who are selling whatever stock or whatever it is, right? So the problem is that there has been not enough liquidity to fund the market. So when people stop wanting to buy these bonds, now the banks can't sell them, they can't raise cash, and as these transactions are happening in the market, that is causing the market to sell off. There's not enough money to fulfill bids, and stuff like that, and bids disappear. So people, they don't want to be buying stocks; they want to be hanging on to their cash. So all of a sudden, if I got a stock and I've wrote it up to like from $10 to $40, well, I want to sell at that $40. Or sorry, no, sorry, say the stock's gone down to now $36. Okay, I see it going down. I want to sell. So I want that money. So the problem is now there's nobody buying it. Nobody buying this stock. So I have to constantly lower my ask price. And that's where you're seeing this big cascade effect in the market, where it's just like sell off after sell off after sell off, and there's no money to fund it, and nobody's contributing. So nobody's stepping in to buy it. And this is kind of happening in the repo market too. And that's why we heard the other day that the Federal Reserve is launching $1.5 trillion injection into the market. And the odd thing about that, and they've promised, I think, $1 trillion for the past 3 days, and not a lot of it's getting soaked up. And so their rescue is basically just not working because either nobody has cash they want to give up, or they have cash and they don't want to give it up, or they don't want these treasury bills. They think they're not worth like the collateral. The collateral is no good. So what they're offering me for my cash is no good, and that's where you're seeing rates start to creep up. So, and this is a big problem. So initially, the rates were up here around 2%. They sold off hard in the initial stages of this drop because everybody was fleeing to bonds. Bonds were the safe thing, right? And they initially fled to bonds, and then they realized they're all dog shit, and now they're fleeing. They're not buying them. They're not buying the long-term bonds anymore. There's just I think, and there's a lot of just theories out there right now about it, that people just have no faith in the long-term debt. There's just too much of it being issued. And I mean, they're just going to issue more. I mean, they're talking about all these stimulus packages and bailouts that are trillions of dollars. And I just listened to an economist talk today about what he thought even just Canada might need to get out of the, or create enough money, inject enough money into the economy to get out of the recession that we are definitely now in. And he's figuring like billions, like almost hundreds of billions of dollars, which is big for Canada. Trillions of dollars in the States, maybe 20 trillion, which is crazy. So, and the biggest problem with that now that they're going to go on this binge fest with debt, and they've already have been for the past 5 years. I mean, the United States has the highest debt outside of wartime that it's ever have. And I'm not 100% sure. I'd have to look it up, but it might even broke that record. So when you have rates going up like crazy, well, now the government has to refinance their debt at higher rates. Well, what does that create? That creates solvency issues. You're bankrupt. So there could be massive write-downs of debt. And I mean, you're looking at that in a sovereign scale. It's huge. So it's really hard to say what the response to that is. There's some theories out there that say that Trump will eventually try to devalue the dollar to offset that and create inflation. And I'm not going to get into the inflation part of it today because it's a whole other ball of wax. It's pretty complicated. Well, I'm going to save that for another live stream, and we'll talk about that more. For now, we'll just stick to this. So, and I kind of think that theory could be credible because I mean the whole Trump presidency, he's treated the presidency like he treats his business deals. And if you know about Trump's business history, he has strategically defaulted on debt in the past in order to keep his business going. And you know, when you default on your debt and go declare bankruptcy, you don't necessarily go out of business. You could still survive as a business. And I think it was this casino that he went bankrupt in. It's still around. So he could be looking at that as an option. I mean, I really hope he's not, but I feel like he's digging himself into such a debt hole that it might not even matter at this point what he's planning. It might just happen. But that's has big consequences for the world. So a lot of crazy shit happening there. And I mean, we're seeing the same kind of behavior in Canadian markets too. Our government's doing the exact same thing. Our central bank injecting all this money, and you know, before you see this curve was pretty flat, so that means all the interest rates are roughly the same. So these go I don't know why I can't see the name on them. Maybe just because of the. So here you go. So these are the lengths of the bonds: 1 month, 2 months, 6 months, 10 years, 20 years, blah blah blah. They all kind of were around the same interest rate, which is not necessarily even a good thing. Um, but lately, I mean, you look at how much the long-term bonds have gone up. I mean, you're looking at what the this is the 10-year gone 76% in 1 week, 98% in 1 week. So overall, if these keep on this trajectory, it's going to cause a lot of problems. And this is where this is one of the reasons why the central banks are injecting so much money into the economy and cutting rates, because they need these rates to stay low. If they if they end up climbing up, it's a huge problem for the economy. It's a huge problem for our national debt and financing it, and it could lead to bad things. So um, yeah, everybody kind of looks at low interest rates as like a good thing. Okay, well, I can refinance my house cheap, and everybody's been saying it's been great that interest rates have gone down, and while that's good for uh, current mortgage holders, you do want to lock in at these rates eventually, because they probably will have to go up as inflation increases. And given that the amount of money that they're pumping into the system right now, inflation will increase. But I will get to that again in another episode. Um, so yeah, and I don't see how really anybody's going to be buying houses in the next 6 months. I mean, there's going to be very few and far between as far as business goes. Business is going to be pretty much shut down. We're already seeing that happening in a lot of countries. So I would expect the housing market to seize up. Um, and I imagine too, with the price of oil, especially Canada being the oil producing nation it is, this is not going to be helping jobs. There's been a lot of companies that have been slashing capital expenditure budgets for next year or for this year. And, obviously you're getting a slowdown in the money moving, slowdown in investment. That means nothing's getting built. That means no more construction jobs to build it. And we're going to see further layoffs in the economy. And that's just kind of has that cycle effect of kind of bringing things down. And I got into a discussion with a guy on StockTwits today about a certain energy stock, and I was basically telling him that um, you know the whole market mentality in people right now is going to change. I mean, this when you see this wealth effect hit hit people from their basically their portfolio value collapsing, uh, it it really changes consumer sentiment. So you're going to see a lot of people trimming their spending. So not a lot of money's going to be moving in the economy. And that's going to create a little bit more problems, obviously, because that's less things being produced, less things being bought, less services being used, and that has effect on jobs. When that scales all back, people and companies will have to scale back their employees, make cuts, that sort of thing. So it all kind of ends up in a recessionary cycle until it becomes cheap enough where people can actually start affording it now, putting the money in back into the economy, and things pick up again. So yeah, okay, one sec, cough break. I lied, it was a beer break. So um, so how did we kind of get to this mess? I gave you the analogy of the wall. Even so, of the wall being like this. So the one shaky foundation holding up this whole fucking thing, and I told you it was years and years of setting it up, of a rotting foundation, and a lot of it, and I really hope people kind of realize what the causes of this are, because there's going to be a lot of government officials not wanting to explain the real reason. I don't even think a lot of them know what the real reason is. Like hardly any of these guys know anything about economics or how markets work, and that's one thing you have to consider too. And one thing that's been strikingly apparent to me in the last couple months, and I'm sure apparent to everybody else too, especially in the last couple weeks with how the situation's got out of hand, is that people in government are really no smarter than you or I. They're just average Joes, most of them. There's a few smart guys that have good ideas, but overall, the bulk of them is just made up with just average people, and So you're not getting uh, the brightest minds in government that can come up with the best solutions, and a lot of them now are going to be more concerned on ass covering than they are on telling you the truth of what's actually happening in the economy and what's actually happened to get us here. And especially from the Federal Reserve and the Bank of Canada, because you knowing the truth about how their decisions have led to this mess is a whole threat to their institution and their jobs and their way of living and their credibility as people, like their whole careers. So they have an interest in not really admitting to their mistakes. And I mean, like, you guys know exactly what I'm talking about. A lot of people, it's hard for them to admit their mistakes because it just, nobody wants to look bad. I don't, if I fuck up something in my basement renovation, well, that's on me. Nobody's really going to know about that. But if I go build a house and I fuck up that renovation, well, now I got somebody to answer to, and that makes me look bad, and I'm probably not going to get a job again. So there's that kind of thing at stake here for those bankers, and and they are at fault. They are responsible for what's been happening in the economy the past 20 years, and it's not just one person or the current guy, which for Canada is Stephen Pallaz, and for the Federal Reserve in the United States is Jerome Powell. And they're not necessarily at fault for the whole thing. They're only in here in terms. I think Pallaz has been in 6 years or something like that. But their predecessors are also to blame. And one thing you can see here is the decline in interest rates. So this is the Bank of Canada rate. So they set their lending rate to banks, and so that basically, in a nutshell, influences the rate at which we can borrow money from the banks. Excuse me. And so, as you can see here, that's been on a steady decline since the 1990s, and it hit rock bottom in 2008, and we're going to be at rock bottom again. We're at 0.75. The United States is at 0.25, I believe. Trump's calling for negative rates. Maybe they'll go there. I don't know, and that's not a good thing. If you're thinking the bank will pay me for lending me money, well, no, they won't. Ask yourself, would you lend money to somebody and pay them to do it? No, fuck no, you wouldn't, and the bank won't either. So that's where a credit cycle is going to turn in. You're going to see a slowdown in credit, and that's another part of the economy. But anyway, so getting this, so as the interest rate gets lower, so you can see the household savings rate has gotten lower, and you can understand why. If you don't have a high enough rate and it's not worth it, you're not going to save your money. You're not going to put your money into the market, or sorry, into the banks. You're gonna go out and spend it. And you're gonna get debt because debt now is cheap. If you're only paying 2% on a mortgage, that is ridiculously cheap. You're almost getting uh, basically like a free loan. You're paying very little on interest compared to what they paid back in the 80s. And you can see actually, and this doesn't extend for some reason to I don't know why, but in the 80s you had skyrocketing interest rates, and that's why you saw the personal savings rate climb up so high, just because it was worth it. It was worth it to keep your money in the bank because the government was obviously paying you a good price on it. You're getting a good interest rate back, and now that's been in such a downtrend for so long, and we're at historic lows for our personal savings rates. Um, Nobody has any money cushion, and now when a crisis like this pops up, like this coronavirus thing, where people need money, we don't have any. We don't. Nobody has any money. I think the average Canadian, I remember reading, it has like $600 in their savings account, and you think about how much your monthly bills are, way more than that. I mean, who has bills that are only worth $600? Like a student, maybe. So that's where one policy decision that has basically leached the savings out of the economy, and where they should have been higher, because when you have more savings in the banks can take that money and use it to loan out in the market, and it creates more investment. So like your money doesn't just stay in the account and it's only yours, and the banks don't touch it. No, it doesn't work that way. So they take that money and they use it to build up more loans and loan out more money, and that has a compounding effect. and that's how they create investment in the economy, by loanable funds. So now that there is none of that, most of it's been taken on in the form of debt. And, this is personal debt right now, but I mean, if you look at uh, business debt, government debt, it's all the same kind of deal. It's all in this huge upward trajectory. And by them providing such low rates, it's levered up the system so hard that now we're in this conundrum where businesses aren't going to have access to cash. And this is one of the reasons you're seeing them hoard it. Um, and they're not, they're not going to have incomes. Almost derailed my train of thought there. They're not going to have incomes to fund their debt. And now the government's talking about, okay, well, you got to stimulate the economy more. And that means going further into debt. And that's been a huge problem. And it's obviously, like you can see here, it's seizing up the market. And the market's starting to price in this risk. They finally figured it out. This stock rise, this bull market, this was a mania. This is 100% a mania, fueled by cheap money, which is interest rates and money printing. And that's what the banks have basically been doing for the past 20 years. They've been printing money. So if we look at try to search it here, it might even be too, so we'll go government debt. Yeah, you can see similar trajectory. I mean, they started paying it off in 2008 and it went up again. And there's another policy decision that has got us into this is the fact that in booms, so we had a boom from 2000 to 2008, which was again fueled by low interest rates, and it's phony. It's kind of phony it's stimulative when you have those rates that low. And so in a boom, you're typically supposed to be reducing debt because you have more money in the economy, more businesses coming online, so that's more tax revenue. Less people are unemployed, so then you're not paying as many unemployment benefits. So those go down. So you're basically, your government revenues are increasing and your expenses are decreasing. And so that's where you have a government is able to pay down its debt. Well, until the crisis happened and they had to shoot right back up into debt again. And that's what's going to happen again this time. But the problem is with this case is they haven't been able to pay the debt down at all. So we've been in a deficit while trying to maintain economic expansion. So essentially, we've been putting our economy on life support to keep it going, and it's just slowly dying more and more and getting weaker and weaker into the fact that we don't have much life support left. Like, if you're already at debt levels this high and the economy is not expanding in a boom, what more is more gonna money to do in a bust? How's it gonna help? So that's the major problem here. That's a policy error on the part of government. I mean, a long time ago, government should have been reducing budgets in order to keep us with a balanced budget or even a surplus. And companies should have been, again, keeping their budgets in balance and not borrowing heavily, which a lot of them have done, and a lot of them use that borrowed money to finance stock buybacks to keep their share price high. And a lot of us are also culpable in this because our pensions are invested through these big funds that also invest in these companies. And so it's this big messy chain that's happening here. But primarily, I hold government responsible because, I mean, these interest rates are government and government only. And the amount of money that they're pumping into the system and the amount of debt that we currently have in our economies is the fault of the government. We could have run a fiscal surplus. We didn't. We went further into debt, and now the average citizen who loses his job is going to have to reap the whirlwind, unfortunately. So yeah, I don't know if you guys don't have another drink in your hand. Maybe you should go get one now. Pretty crazy situation. Pretty crazy market, and it's not going to stop from here. So as far as the market bottoming, I don't know. We'll have to watch this and see what happens here over the next week. So again, on Friday, I'll do another podcast, or sorry, another live stream, and we'll be able to look for some more signs and see where things are at and see if there's going to be a turnaround. But I'd say, given the amount of problems that I just listed to you and the picture that I've just painted, we're firmly in a bear market, I believe, and that's not going to be changing anytime soon. So returns on stocks are not going to be what you've seen here. I mean, going almost doubling in the past few years, you're not going to see that for a long time. So when the market kind of wakes up to this, it's going to be a whole change in the way things are moving. And so I'm going to get into the gold market on Friday, because all the problems I've listed here have maybe a future impact on gold, especially when you have people looking for safe havens, which in this case they've been fleeing to the dollar. So when they've been fleeing to the dollar and now they have all these debt and nobody wants to buy the treasuries, maybe the dollar won't become the safe haven it's perceived to be right now, and then you'll start to see people fleeing out of it into gold. But I'm going to get all that into that on Friday. I'll be able to give some more insight into that. I don't believe gold is done bottoming yet. I think people are just selling it off, and what I've heard is a lot of that's used to fund margin calls. So like hedge funds and big investment funds that are now seeing their stock portfolios drop hard and they're having to make margin calls. They're selling off that gold. They're selling everything they can sell in order to get the cash to finance these margin calls, because if they don't, they can completely collapse just like that. So yeah, until that stops, the market will not find a bottom. Who knows how long it's going to stop? I mean, this similar kind of action hasn't really happened since. I mean, they're comparing it to 1987, but I think it looks more like 1929, to be honest with you. And that market action, well, the initial panic crash didn't stop for over a month, I think 2 months, and then it's recovered for I think about 4 or 5 months, and slowly started going down into a bear market, and bottoming I think like a year later, year and a half later, or something like that. So took quite a while to sort out, and I think we are nowhere near sorting that out yet. And like I said, with the amount of money they've been throwing at the system and it's not helping, that is evident that this problem is just not going to go away like that. I mean, it's going to be around here for a little while. And this coronavirus thing isn't really getting much better. So there is that factor too. But again, I don't believe that this is the cause of it, or sorry, the cause of the continuing problems that we're seeing. I'd say the coronavirus is the cause of this, and then the rest of this is just systemic risk and rotten structure. So sorry for being negative Nilly there, folks. I know a lot of people don't want to hear this kind of shit, but it is also important that you do know it and do be aware of the risk in the market, and don't be thinking that now is the best time to get into stocks, or try to buy the dip, because they have a market term for this, and that's catching the falling knife. So I mean, like, I'm not telling you to do this, but if you drop a knife out of your hand while holding it above your head and then try to catch it below, I mean, yeah, you can see where the analogy comes from. It's not good to catch a falling knife, and it's certainly not a good idea to be buying during this waterfall. And as you can see, probably some people did try to catch the dip here and ride this up, and it didn't work. So I mean, it's happened a few times. So just be careful out there. Be patient. Patience is key. If you have extra money and you want to catch a market bottom, just patience, grasshopper, patience. It will come. I'll be providing some updates in gold. Also, I will actually update a list or something, so I can give to you guys to follow other people. Like I follow a bunch of economists on Twitter, StockTwits, and a bunch of traders on there as well, who actually provide a lot of good insight and really help me to formulate my opinions on where I think things are going. It's good to listen to other people, get other perspectives. So I'll do up a list for that on the Friday stream, and yeah, if you guys want to check those out, then feel free. So until then, you guys can feel, like what you see here. Hit the follow button on Mixer. If anybody has a created account, it is super easy. It's through Microsoft, so if you have like an Office Online or Microsoft Outlook account, you can just use that login info to go into Mixer. And I think you just got to like create like a little profile with a nickname and shit like that. But you don't even have to like put a profile picture up. It's not necessary. So you can hit the follow button there. I am on StockTwits. Same name, same ugly profile picture. Stocktwits.com/bestiuk. You can follow me on there. I do provide some targets. I do have some targets here for energy stocks, and then these are all Canadian energy stocks. And I've done some analysis and some charting in the interim between the live streams. So if you want to catch more info until then, just hit me up on here and just keep your eyes peeled. Okay, y'all. Anyway, be patient out there. Protect your money. Don't get the coronavirus. Stay healthy. Stay inside. And I'll catch y'all on Friday. Peace.